A warm welcome to everyone joining us here live or watching the recording of this webinar. We're pleased to have over 800 participants who registered. Those come from about 70 different countries. My name is Felix Goltz. I'm Research Director at Scientific Beta. Today's presenter is Riccardo Rebonato. He's professor at EDHEC Business School and a director at its Climate Institute. To give you some context, so Scientific Beta is a spin-off from EDHEC Business School. We work with institutional investors to help them address investment outcomes with systematic equity strategies, and those come in a transparent and systematic index format. So if you're interested in Scientific Beta, you can find out more about us at our website, scientificbeta.com. Now, beyond our products, we support research on questions that investors care about. Clearly, climate risk is a key issue for many investors, and that is why we support research at EDHEC Business School on this topic. Today, Riccardo will present his work on assessing the impact of climate risk on global equity valuations. The format of today's session is, first of all, there will be a 45-minute presentation, and this will be followed by a 10-minute question and answer segment. You can submit any question during the presentation. Just use the Q&A function, which you find at the bottom of your screen. We will address as many questions as possible at the end of the presentation. If we run out of time, don't worry, we will still provide you with answers to your questions, and we will actually, answer our give our written answers and send them to everyone that has registered to the webinar. And also we will share the presentation slides with everyone after the webinar, and you will also receive the research paper later on if you've registered for the webinar. And now I'm pleased to hand over the floor to Riccardo for the presentation.
Thank you very much, Felix, and thank you for all the delegates for registering and listening to me. Good morning, good afternoon, and good evening, wherever you are in the world. As Felix said, the topic of my presentation is the impact of climate risk on global equity valuation. So let me begin by giving an outline of a session. I will describe how we approach valuation, and I am stressing here that the valuation I'm talking about is a valuation of equities as an asset class. So I'm not looking at specific sectors, but I'm looking at equities in their entirety. And what underpins and makes the treatment that we are presenting, I wouldn't say unique, but uncommon, we are adopting a fully probabilistic approach. We emphasize the importance of state-dependent discounting, and I will explain what that means. We look at transition and physical risk together, and all these valuations will depend on the particular abatement policy that is followed. I will present the results, I will discuss the results, and I will bring everything together, hopefully in a convincing way in the conclusions. So, in this talk, we are using in a novel way established techniques. So I am stressing novel and established. The techniques that we are using are part of the standard tools, analytical tools in asset pricing. So we are not making it up as we go along, but we are combining them in a novel way in order to answer questions about the impact of climate change. And I'm saying climate change, not physical or transition risk. And there is an important part of which I will dwell in a while, on equity valuation. And as I said, the key ingredients are putting uncertainty center stage, putting state-dependent discounting as center stage, and treating together transitional and physical climate damages. And what we conclude from our analysis is that losses can be large for plausible combination of outcomes. I'm talking about plausible because clearly there is uncertainty. It's my first point. There is great uncertainty as to the possible combinations of climate outcomes, but there are plausible combinations that give rise to large losses. And I stressed from the beginning that one of the determinants of whether the losses are going to be large or not large is our abatement policies, so how aggressively we decide to abate emissions. To some extent, or rather to a considerable extent, our results are different from what has been reported in literature, in the financial press so far, and we believe that they are important. And when I say different, they are probably more severe, the losses that we find for plausible combinations, than has been so far reported. But I would make the case that our estimates are, if anything, conservative. So, as I said already, and I want to stress again, the three original aspects is embedding our treatment in a fully probabilistic setting, giving importance to state-dependent discounting, and I will explain later on why we have to look differently from the discounting point of view at transition risk and physical risk, and provide a unified treatment of transition and physical risk. We are looking at the impact of climate change on equity valuation for a variety of abatement policies. I do not know better than anyone else what abatement policy will be followed in the next 20, 30, 40, 50 years. And therefore, we have a range of plausible possible policies, and I will give a valuation effect for each of these policies. And also, I'm looking at the possibility of tipping points. Tipping points, as you know, explained very quickly, are describe the possibility that the climate change, as it has done in the climate past, might change abruptly once one or more particular threshold temperatures are reached. We know very little about tipping points, but we know that they have occurred in the past. And therefore, looking seriously at the possibility of tipping points is important. I stress, clearly, if we have tipping points, the equity valuation adjustment is more severe, but I stress that we do not find large adjustment to equity valuation only with tipping points. Okay, so let's begin with the intuition. We are taking a top-down approach. What do I mean by that? I am looking really from 30,000 feet down, and I'm saying, what do equities holders receive? Actually, what do the holders of any securities receive? They hold pieces of paper that entitle them to a fraction of what the economy produces. A part of what the economy produces goes to labor, and a part goes to the providers of capital. So the providers of capital are these people who got pieces of paper. Some are equity holders and some are debt holders. And therefore, if climate change via the transition of a physical channel reduces the output of the economy, then what these ticket holders can receive will be impaired. The distribution of the economic output will be negatively affected. And this is the top-down approach that I am taking. And then I'm looking at equities. And an important thing about equities is that they are a leverage claim on consumption. Merton had, I don't know if it was the first, but certainly it is associated with the name of Merton, the idea that equity is a call option on the assets of the underlying firm. And therefore, since it is leverage claim on consumption, it depends on changes in consumption more than linearly. There is a huge literature that looks at equity as a leverage claim in consumption. And as I said, this is the established part of the literature that I am looking at. So in our approach, the dividends are linked to consumption. You can think of a dividend for this global equity as consumption in a particular state of the world raised to a power, which we have chosen conservatively to be a power of 2. I'll come back to the choice of this experiment later on. Does it make sense to look at dividends as a leveraged claim to consumption? Yes, it does. If I think of the CAPM case, with which we are all familiar, without leverage, in a CAPM world, a doubling of future consumption in every state of the world, so we are twice as rich in every state of the world, would have no effect on equity valuation. Why is that? Clearly, we would have greater cash flows, greater dividends, but they are discounted more. And this tug of war between discounting, and cash flows is at the heart of what I'm going to present here. Now, I have said that one of the key features of our approach is a probabilistic approach. At the moment, there are lots of scenario analysis. There is the SSP, shared social economic pathways, RCPs, representative carbon pathways. There are the NGFS approaches. These have been very useful, very important scenarios which have been created by very strong academic teams. However, they focused, perhaps understandably, for the purpose for which they were created, but they were focusing on the most likely parts. Now, I remember the dictum by Milton Friedman, never cross a river just because it is 4 foot deep on average. And therefore, we have put the full probability of distribution of the 2 greatest unknowns in climate modeling, which is GDP growth, how much of the economy will grow, and damage uncertainty. What damage it will be associated with a given temperature anomaly. We make use of the most up-to-date modeling of climate physics, damage functions, and economic growth to create, via simulation, the probability distribution of interest. Using a fully probabilistic approach yields different answers from deterministic models based on the most likely outcomes. We produce greater losses because of, I'll show you a picture in a second, non-linearity of losses, and the second bit will become more clear later on, the effect on state-dependent discount factor. So this is an illustrative figure just to show the importance of having uncertainty. I have assumed a totally symmetric distribution of temperatures at a certain horizon. We have every reason to believe that the temperature is not symmetrically distributed, but just to make things really simple, here I have a distribution of temperature, which is our nice bell curve centered on 2.5 centigrades. And here I have a distribution of damages, which is associated with this very symmetric distribution of temperatures. And what you notice immediately is that the distribution of damages is no longer symmetric because the damages are not a linear function of temperatures. Therefore, if I look at the damage associated with the average temperature, say 2.5, is different from the average of the damages associated with, say, 3 and 2. So that is where one of the reasons why a probabilistic approach is so important. And then I said that, so this I think is very easy. Everybody will accept this. Yeah, absolutely. That makes a lot of sense. The second one, perhaps I have to do a bit more of a sell. Why do we need state-dependent discounting? In our Monte Carlo simulations, every cash flow is discounted by a discount factor that depends on time, easy to understand, and state. Why should discounting be state-dependent? At the heart of modern asset pricing, there is the following concept. Investors do not value the same future cash flow in the same way, irrespective of whether it happens when they feel rich or when they feel poor. The same cash flow received when you're rich is valued less than the same cash flow received when you're feeling poor. This is at the heart of equity risk premium and any risk premium in general. From the economics point of view, it comes from the desire to smooth consumption over time, but it reflects a very, very intuitive understanding. If a strong cash flow occurs in a bad state of the world, that is hedging, and I am ready to pay even an insurance premium to get that cash flow. That is a negative risk premium. On the other hand, I don't like fair weather friends, so I don't like cash flow that occur. I don't like as much cash flow to occur when I'm feeling rich, and therefore I degrade their value today. And you might say, okay, yeah, I understand where you're coming from, but is it really such a big effect? Well, let's look. This is just a super baby example. Consider riskless rate at 2%, equity risk premium of 5%, standard numbers, a price of equity of 100. You can work out, in order to discount this cash flow from infinity to today, you need a dividend growth rate of about 4.4%. This is just for illustration purposes, nothing very precise. I say these numbers pass what economists Weizmann used to call the love test. Now, what would be the price of equity be if the risk premium were zero? We observe a risk premium, saying 5% is actually quite conservative. What would you guess the price of this equity would be if we didn't have risk premium? Very brief calculation is this staggering number here. Instead of being $100, it would be $760,000. So the effect of state-dependent discounting is huge. And the effect on equities for state-dependent discounting is huge. And that is why we have to take it into account. How does it come through? Well, it comes through because of the different discount factor. This is discount factor, the bottom line that I obtain with an equity risk premium of 6%, in which case a cash flow occurring in 50 years' time is basically invisible, it's completely discounted away. And the orange curve shows the value of the same cash flows discounted with a zero risk premium in 50 years' time. For instance, here I can still see 35% of its value. So key to our treatment is looking at state-dependent discounting. You say, oh, right, that's all a nice theoretical argument, but does it really matter in practice? Yogi Berra, in principle, there is no difference between theory and practice. In practice, there is. Yes, it does make a big difference in practice. If you think about it, the so-called Greenspan put, i.e. the policy by the US Fed and by central banks in general, roughly from the 1990s onward, to lower rates in periods of economic distress is a suggestive parallel of this state-dependent discounting. When the economy is weak, when the economy is in a weak state, interest rates tend to come down. Interest rates down means that future cash flows are discounted less, and therefore they're more salient today. If you cast your mind back to the period right after the great crisis of 2008 and 2009, in 2009, equities began rallying, but it was hardly an expectation aspect. The rally in equity prices was mainly driven by the very aggressive, the ZIRP, the zero interest rate policy, the very aggressive cut in rates that we had at the time. And the effect on valuation was dramatic. So especially when you have a very long dated asset, an infinitely dated asset as equity, discounting is very important. And again, here I have a graph, which is a running correlation of treasuries with returns with S&P 500 returns. So roughly here, so before Greenspan in this period here, there was a positive correlation. And what this is showing is that after the Greenspan years, there has been a negative correlation. So weakness in the economy, weakness in the equity markets has been countered by a lowering of rates, with the exception of the last, and we come back to this later on, of the last few years, because we have had inflationary pressure and all of a sudden things have changed. We'll come back to this point in a while. Okay. Then I have said that the third element of difference between the way we look at valuation and many other approaches is that we look at transition and physical risk at the same time. I prefer to talk about transition risk and transition costs. It will be a long discussion. Allow me to use the term cost for transition rather than risk. The reason that risk points to the uncertainty. To me, the saying risk is what I don't know about the central expectation. But the first thing that I want to know is what do I expect the transition cost to be, and that is what I'm focusing on. Now, transition costs are incurred by companies because of direct producer or consumer taxes, quantity controls, price controls, cap and trade, etc., etc. Weizmann has shown that if production costs were perfectly known, then all these measures would be perfectly equivalent. In the real world, they are not, because we do not know the production costs, etc., etc., and therefore some of these levers are more efficient than others. However, for the purpose of my analysis, I assume that these differences in efficiency between limiting emissions of CO2 via consumer taxes, producer taxes, quantity controls, price controls, cap and trade are limited. And I am looking, therefore, at all these elements as transition cost. This is a cost imposed by, you can think of a carbon tax, even if we don't apply explicitly a carbon tax. Think of it as a carbon tax equivalent. And I'm stressing this because carbon taxes, which are loved by economists, are not loved as much by the electorate and by politicians, and therefore carbon taxes as such are not as common as economists would predict them to be. Okay, now, there has been a lot of attention which has been paid to transition risk. I'm making one example out of many. I'm looking at the Norwegian Sovereign Wealth Fund, and using an MSCI projection tool, they predicted an estimated percentage loss for an equity portfolio under SSP2. Now, SSP2 is one of the shared socioeconomic pathways which have been created under the auspices of the IPCC, and it is the middle of the road one. So middle of the road, you have a middle of the road scenario, and given this scenario, you have different possible RCPs, different possible emission patterns. They're not really emission patterns, but we can make them equivalent to emission patterns. And there is one emission pattern that keeps us under 1.5, another emission pattern that keeps us within 2 centigrades, and one emission pattern that keeps us within 3 centigrades. And the way these things work is that you put your socioeconomic story, which is the SSP, you put the emission story, and you link the two via the carbon tax, which is exactly the approach that I'm taking. With the difference that in the SSP RCP approach, you only have one scenario, whilst I'm considering the full spread of uncertainty around this. But let's go back to transition risk. Now, let's look what the results were of this exercise. They said the adjustment, the percentage loss for an equity portfolio under the SSP2 was 8% if the temperature is kept under 1.5 centigrades, 4% if it is kept under 2 centigrades, and only 1% if the temperature reaches 3 centigrades. Now, in a way, it is both self-consistent and puzzling. It's true, we're only looking at transition costs. And therefore, what does it mean? If I am keeping the temperature under 1.5, which is an extremely ambitious target this day, the expenditure, the cost, the carbon tax, the corporate, think of it as a corporate tax, if you want, is high. And if the temperature reaches 3 centigrades, I've done very, very little, and therefore my transition cost is very small. This is all, I don't know whether these figures, but I definitely agree with this trend. And then we can quibble if it's 8 or 6 or 7, but this makes perfect sense. However, my question is this really what investors need? Is this really what investors need to know? Let's think for a second, 3 centigrades. The human species, let alone civilization, has never seen a 3-degree temperature anomaly. If we reach 3 centigrades, we are in completely uncharted territory. So it might very well be the case that the impact from transition risk is only 1%. But is that really what we should be worrying about? Let me do some sanity checks. There has been a recent Harvard working paper by Bilal and Kerzik, and they have found, it's a very, very nice paper that I strongly recommend, by the way. They've used innovative techniques in order to estimate the damage function, the effect on GDP of temperature increases. And they find that a 1 centigrade warming would create a 12% fall in GDP. Allow me to use linearity, which is super conservative. So 3 centigrades, roughly, there should be a 36% fall in GDP. Now, if I have a 36% fall in GDP, is the 1% loss in equity value due to transition risk really what I should be worried about? Are we focusing on the right numbers? Now, we are doing, this is from another paper that's perhaps I'll talk about to you another time, but this is looking at transition and physical risk together. What do I have here? I have a histogram of cumulative transition fraction, so the fraction of transition costs a fraction of GDP, and damage fraction for in the year 2100 for 2 different temperatures. One is the temperature of 2.6 and the other one for the temperature of 1.8. But look at the right one. What I want to focus your attention is, look how much along the diagonal, how strongly correlated these 2 quantities are, which makes a lot of sense. If I spend a lot on transition risk, I have few physical damages. Conversely, if I don't spend money on transition risk, I can expect a lot of physical damages. So the 2 things are strongly negative correlated. You have the body of the mass that goes along the anti-diagonal of this XY plane. Now, the rationale for the prevalent focus on transition risk is well known. We say, well, there's a difference between front-loaded versus remote and discounted costs. There is one quote amongst many, and Faccini, Martin, and Schiadopoulos. And they have looked at to what extent physical and transition risk are reflected in prices, and says we uncover 4 novel risk factors related to natural disasters, global warming, international summits, and US climate policy, respectively. Only the climate policy factor is priced, especially post-2012. So what is the rationale? The rationale that all the other damages are so far in the future that are effectively discounted away. But whether they are discounted away, it depends on the discount factor. And remember, one of the things that I was talking about before is that we should make the discount factor state dependent. When the economy is in a contractory mode, rates get lowered. And by getting lowered, the discount factor becomes, so the discount rate becomes lower, the discount factor is higher, and these damages are no longer so far away in the future. So the relevance of physical climate damages for equity valuation should be the result of our analysis, not of our prejudices. So the question is, which risk premium should be applied to physical and transition costs? Let's pause here for a second. And again, I'm stressing here why looking at the state dependence of discounting is so important. One way to look at transition risk is the following. We have a commitment or some rules or some laws that says, no matter what, by 2030 or 2040 or 2050, whatever, you will have to undertake certain measures, no matter what. No matter what means in every state of the world. So if I incur these costs, these transition costs, in every state of the world, there is no dependence with feeling rich and feeling poor. And asset pricing theory tells me that this cash flow should therefore be discounted at the riskless rate. Since there is no what is called covariance with my consumption, they do not attract a risk premium. Conversely, physical damages, as we shall see, are very strongly correlated with consumption. So immediately this is telling you, using a one discount factor fits all for physical and transition cost is unlikely to be a sound practice. Okay, I'm conscious of the time. How do we approach valuation? We look at different abatement policies. So what do I have? You can roughly look at these curves here, not precisely, but for intuition, I think it is good enough. You can look at, say, the green curve that roughly gives me the degree of decarbonization of the economy at a certain horizon. So the green curve here gives me, say, in 30 years' time, the economy will be 70% decarbonized. I don't mean electricity, I mean all sources of energy. So I have looked at these 4 possible abatement schedules, characterized by the letter mu, that describe different degrees, different speeds of decarbonization. What have I looked at? With the most aggressive one, the expectation of the end of century temperature will be roughly 2.1 centigrades. With the next one, 2.25 centigrade. With the next one, 2.5 centigrades. With the next one, 2.83 centigrades. And finally, with the last one, this very, very low one, above 3 centigrades. The lowest temperature, 2.1 centigrades, approximately maps between the SSP1 and RCP 2.6 and the SSP2 RCP 4.5. 2.6 and 4.5 corresponds to forcing, we describe forcing. We won't go into that, but you can map it into temperatures. The highest is maps between the SSP2 RCP 4.5 and SSP3 RCP 7.0. For people who luckily don't spend all their life looking at RCPs 4.5 and 7, what does that mean? Well, a forcing, so 7 is a forcing of 8 in watts per meter squared has been described by Hausfather and others as implausibly high, but on the other hand, Schwarm and others have said that so far we are actually along this path. So basically, the spread of abatement that I am covering goes from very, very good news. We are going to keep basically within 2 centigrades by the end of the centuries. And, I beg your pardon, looking at here, this is the bad news. We are not quickening the pace of abatement and everything in between. So these will be the 5 abatement schedules that I'm going to look at. And as I have said, one of the big sources of uncertainty is the damage function. What is the damage function? It is the function that translates a temperature increase into a damage. Damage is a reduction in GDP. Reduction in GDP is reduction in our dividends, remember. And at the moment, there is a huge amount of discussion about what this exponent A3 should be. If it is 2, we have a quadratic. If it is greater than 2, it is cubic or whatever, and 1 will be linear, etc., etc. There is a huge disagreement, and the attitude I have taken is I'm no cleverer than anyone else, and therefore I've looked at the best surveys in the literature, and I have applied a distribution of this exponent here, which remains centered around the consensus view, but allows for much, much higher damage experiments. So in here, I will have a much greater damage for the same temperature, and down here, lower damage. So this is what we're doing. And last thing, I'm also assuming in a separate analysis, not all together, I'm looking at them separately, I'm also looking at the possibility of tipping points. And therefore, I'm saying that if the temperature anomaly goes above 2.5, it begins to climb very quickly, up to a total loss of up to 30% of GDP. Okay, let's look at the results now. And before we get started, we show the results both with state-dependent discounting and with no risk premium these are the number in square brackets. The number in square brackets that you will see soon have no risk premium attached to them. Let me be very clear. Cash flow without risk premium, it doesn't mean that they are discounted at today's riskless rate. They're discounted with the same average discount factor as the cash flow discounted with the state-dependent discount. So if I have in the year 2100 a state-dependent discounting, I can use it to discount cash flows, and I can also discount cash flows using the average discount factor for that time. The average discount rate is neither higher nor lower on average than the state-dependent discount rate. So let's begin to look at some numbers. First, this is the case that is like the benchmark case. What do I have here? These are the different abatement speeds. And as a reminder, I have put the associated temperatures from 2.1 to 3.3 on this axis here. And on the rows, I have different values for what is basically my dislike for uneven consumption, the elasticity or intertemporal substitution. Since people do not tend to have a ready appreciation for this number, I have put in square brackets here the riskless rate that this implies, from 3.6, which is rather high, to 3%. So how do we read this number? This is a loss ratio. If I have 100%, I have no loss whatsoever. 95%, it means that I have a 5% loss. 80% means I have a 20% loss. And these in square brackets are the numbers that correspond to non-state dependent discounting. And you can say, okay, yeah, it makes a bit of an effect, but really nothing dramatic. You know, you got 5%, yeah, perhaps. By the way, I've not put decimal figures because I don't want to give the impression of high precision. But now, let's look. So here, what do I have? I have productivity, the total factor of production, and my damage exponent, both stochastic. This is my benchmark case. Now, here, I only have my productivity stochastic. So my economic growth is stochastic, but there is no uncertainty on the temperature. And here I noticed something interesting, because now there is a very big difference between discounting with state-dependent discounting or without state-dependent discounting. Here, the loss in this case here of very slow abatement would be huge if I were not discounting in a state-dependent way. So this is telling me this state-dependent discounting actually reduces losses a lot. One more. Let me put only the damage exponent to be stochastic. Now, the growth of the economy is perfectly deterministic. Again, there is a significant effect, but now it is in the opposite direction. Now, the state-dependent discounting now gives me a lower loss ratio than with an average discounting. What is going on? Then we're going to look at tipping point. Well, let's look at them now. In the reference case, if I am tipping points, not surprisingly, if I compare with this table here, the losses are significantly bigger. And they can be of the order that go from a 60% loss here to a 12% loss here. One important thing, in all configurations, if we abate aggressively, losses are small, even with tipping points. Okay, you might say 12% is not extremely small, but here we are saying that even in the presence of tipping points, there is nothing disastrous, but it is predicated on an aggressive abatement policy. How do we explain these numbers here? Let me show some pictures before. I'm checking the time. Yes. So you can look at all the details in the technical paper that I put at the end. What I have here is, this is the case where my economic growth is stochastic. And what I have here, my jagged green line is my dividend loss. The change in consumption is my dividend loss. And the blue line here is my consumption without damages. And it is telling me very clear, the biggest damages are incurred in states of high economic activity. States of high economic activity have high discount rates. High discount rates mean small discount factors, and it means that the effect is discounted a lot. Look, instead, if I only had my damages stochastic. Now, damages occur when my exponent A3 is big and there is no relationship with economic activity. So what I notice here is my consumption with damages, which is the blue line, is now very strongly negatively correlated with my damages. The damages are creating the loss in consumption. Loss in consumption is loss of dividends, and therefore the two things play in the opposite direction. Again, I've gone very, very quickly here. I refer you to the technical paper that I put at the end if you want to see all the gory details. Now, what does it take for large losses to be incurred? It depends. It depends, first of all, on the aggressiveness on the emission abatement policy. The slower the abatement, the greater the downward pricing. It depends on the presence of otherwise of tipping points with relatively low threshold temperatures, and it depends on the extent to which central banks are able and willing to lower rates in state of economic distress. Now, able and willing, let me go back to this picture here. Yes, this was a picture of a correlation between monetary policy and S&P 500 returns. It's always been accommodative, so when S&P has gone badly, rates have been cut. However, there is the fly in the ointment. When inflation comes up, then it can become impossible for the central bank to lower rates in states of low consumption, when the economy goes poorly. My model doesn't know about this. So this is why my model is conservative, because my model says that the cavalry in the form of a lowering of rates will always come to the rescue of a weakening economy, which can happen as long as inflation is under control and public debt is under control, but it is not to be taken for granted. So we're seeing rather big numbers. Nonetheless, I claim that our results are conservative. I remember that our dividends are consumption to an exponent. I have used the lowest exponent that is used in the literature, of an exponent of 2. In the literature, you find exponent of 3 and above 3. I have used a relatively tame damage function. Remember, our exponent A3 was centered around 2, a quadratic loss, which has been criticized by many as being too tame. There are no disorderly transition. Many people look at transition risk as the risk, or rather the additional risk, caused by a delayed and therefore rush transition. There are no rush transitions in my model. I've used a relatively high discount rate. Remember these discount rates. This is from 3.6 to 3%. This is the riskless one. If I add a lower, the effect will be even bigger. And I also assume the central banks can always be accommodative, but as you see, that need not be always the case. One big message: we do not need tipping points to obtain severe loss ratios. Now, you might say, Riccardo, your numbers looks higher than what I've seen in the literature or in the financial press so far. How come? Well, I can venture a few explanations. First of all, I am using a distribution of outcomes that brings to the fore the non-linearity of effects. As I said, a 2 centigrade and 3 centigrade temperature increase, average 50-50, does not have the same effect as a 2.5 temperature increase. We have looked at transition and physical costs together. Physical damages are not fully discounted away. Focusing on transition cost only gives an incomplete picture of evaluation effects. We have stressed the fact that the discount factor depends on the state of the economy, not on our prejudices. And we have recognized fully the uncertainty in the damage function, even without tipping points, with some parts being really severe and creating really big losses. This brings me to the last point. You may say, interesting analysis. I hope you would say interesting analysis, Riccardo, but perhaps all of this information is already in the prices. Well, nobody is extremely difficult to tell. Most studies say that perhaps transition risk is reflected in the prices, which is a small component. The physical risk is not. And there have been so many studies trying to detect a climate risk premium, a climate beta, etc., by very clever, very intelligent people. And they've always come up, sometimes with statistically significant results, very rarely with economically significant results. So this is to me like the case of the dog that did not bark in the night. The fact that we fail to find a signature of climate news, climate events, climate something in the prices makes me believe that what is reflected in prices at the moment is very, very limited. A second observation that I would make is that perhaps we are focusing too much on catastrophic events rather than on chronic damages. So there is a strong possibility. So we always think of the hurricanes, the fire, the floods, but when you put all these numbers together, they do not add up to very big figures. And therefore people say, well, at the end of the day, there isn't much. There is terrible, the human cost, etc. But in economic terms, perhaps there isn't that much. I think that there is a chronic aspect in terms of loss of productivity, loss of efficiency, etc., which is less visible, more insidious, and they will create like a continuous drag in dividends growth. So many people say, do you think there's going to be a climate Minsky moment? I think the economists had their term. No, sorry, Haldane, Bank of England economists spoke about a Minsky moment. Minsky moment would imply that there is some events that focuses the minds and all of a sudden people reprice, like the Lehman default. I don't think there will be a Minsky moment because we have had so many events already and they don't seem to have moved the needle. The people who are convinced, the people who are not convinced will never be convinced. I think that what is more likely to happen is what I call the death by 1,000 cuts. So a repetition of not dramatic, but negative surprises in earnings, in announcement, etc., that over time bring about a revaluation of the expected future cash flow. Remember, the price of equities today is expected cash flows discounted by the discount factor. And as a last thing, some of the losses you may say, oh, it's not very much, it's 10, 15%. This, however, if my interpretation is correct, will not be mean reverting losses. So after COVID, for instance, we had a massive GDP loss, but then a rebound. Here, it seems to be like a headwind, a continuous headwind without a rebound. And therefore, that would be a period, a bit like Japan loss generation. It could be the climate loss generation in equity returns. This slide here is more speculative than the rest of what I presented, but I think it was useful and important to point out. I'm coming to the end. Summarizing, we presented our findings on the potential impact of climate change, not just a transitional risk on equity valuation. We have found that the important equity price readjustments can be incurred if we abate little, if central banks cannot counter poor economic growth with lower rates, if tipping points are nearby. Our losses are larger than what has often been reported in the literature. We concur with the literature that physical risk is poorly reflected in the prices, but we have shown that this blanket omission is unwarranted. And recurrent negative earnings surprises may have a greater impact on valuation than headline-grabbing disasters. So that concludes my presentation. I would like to thank you, and I point you to this. There is a technical paper on SSRN, if you want to look at all the gory details of the derivation, over which I have had to skip. Thank you.
So thank you. So we have received a lot of questions. So let's go right into them. So first question is the following. What about individual firms or sectors or countries?
Yes, yes. Admittedly, my analysis in this paper does not look into this. However, I think that it provides a very important sanity check. Let me try and explain what I mean by that. I've taken a top-down approach. Another equally valid approach is the bottom-up, in which you go company by company or sector by sector. It is very useful, but it is very easy to miss the aggregation effect. I can give several examples in which, if I had more time, I'll give a nice example. I'll skip. If I look at the individual losses from firms, it is very difficult sometimes to capture aggregate effects. So if we believe in the conclusions of the study here, this could provide a very important and very useful sanity check by saying, do my sector losses add up to the losses that are in the aggregate economy? If not, either one or the other is wrong. So this is an important sanity check. You may say, my analysis is wrong, we can discuss, but the two cannot coexist without meeting in the middle. So this is of relevance also to sectoral or company level valuation.
So there's a question on practical implications. So I'll just read it. So it says, what is the main implication for asset owners?
Yes.
Do you think in terms of investment strategy, is it just to be more conservative in equity forecast returns?
Well, very brief, yes. Well, but probably I wouldn't say just. It seems to be a pretty important, from the point of view of asset allocation. If my conclusions are correct, we are simply saying the junior part of my capital structure is going to be hit more severely. That exponent there, the lambda 2, is going to be hit more severely than we have expected by climate damages. Therefore, a more protected part of the capital structure might be worth a second look. But again, from a practical point of view, I would stress again this sanity check, making sure that your individual valuations add up to the total one remains valid.
So there's one question, I think, just on clarifying a bit, I think the modeling framework. So it says, isn't the analysis similar conceptually to how integrated assessment models work for estimating equilibrium levels of carbon prices? Although
yes.
stochastic models
Absolutely. However, there is a big difference. The integrated assessment models, a la DICE and many others, make some very strong assumptions. They say they optimize both over the savings behavior and over the abatement policy. That is, in a world populated by totally rational people without political constraints, etc. The key difference here is that we have looked at abatement policy that are not necessarily optimal. So the very slow abatement policy, for instance, is much slower than the slowest policy advocated by DICE, but it is possible. Therefore, we have optimized in our code only on the savings ratio, not on the abatement policy. So that is the biggest difference. Doing a pure integrated assessment model approach would give interesting policy recommendations, but I don't think it would be very realistic because the recommendation of these EIMs have not been followed so far at all.
Okay. Another question I ask is about tipping points. So I think probably just a clarification. So the question says, in the scientific literature, tipping points are points of no return rather than rapid changes in the climate. Is there a reason for using a different definition?
There are many definitions of tipping points. The irreversibility is one feature. Again, we can define anything that we want. If you want to define it irreversible, in my modeling, they're not irreversible and actually makes my results even more conservative. Personally, as an ex-physicist, I don't necessarily regard irreversibility as a distinguishing feature if you want to define it that way. To me, the important thing is there is some feedback mechanism such that beyond a certain point, there is an acceleration in the rate of the change of the quantity you're looking at. But good point. If you want to put irreversibility, all these conclusions would be even stronger. Here, in my approach, you can come back from the dead. In your approach, you can't.
So there's one on the difference between GDP and NDP. So it says, is there a possibility in high temperature scenarios that there will be a large wedge between the impact on GDP and NDP? So yes. It says GDP won't be reduced as much as assumed, as there will be lots of expenditure on replacing climate impacted buildings and infrastructure, but NDP will be. So if there's a difference, what will or should be the impact on the stock market? So
you are saying, well, what you are saying is basically the GDP estimate is wrong, because the sum of the national domestic products should add up to the total of the global domestic product. Sorry, the GDP. To the extent that you say, oh, there is an effect because of mitigation, adaptation, etc., you're basically saying your estimate of GDP was wrong in the first place. We have used the current most accepted modeling of the spread of GDPs. And again, in my spreads, I have, I do not bank on growth in any possible scenarios. I have definite scenarios in which the GDP growth is 0 or even slightly negative, up to a. So we might revisit your question. I see where you're coming from, but at the end of the day, the sum of the NDPs must be equal to the GDP. So what you're basically saying, your estimate of GDP is wrong, which could be.
So one question, I think this is on your motivation or example you presented on the Norway fund, etc. So it just says, while you compare the impact on GDP from the Harvard study to the transition risk only, which I think Norway used from MSCI, because there would be a, also a physical risk measure from these types of analytics.
Absolutely. But what I was surprised in the report that I read, that there was just a footnote about the physical risk. So you're absolutely right. So the point I was trying to make, and that perhaps I didn't make clearly enough, is that I don't have a burden with these numbers, but these numbers seem to be focusing on only a very partial aspect of a problem. If we have 3 centigrade, I would have liked a lot more discussion of the physical risks. And in the NBIM, the Norwegian Sovereign Wealth Fund report that I have read, the physical risk was almost an afterthought. All the focus was a transition risk, and it seems to be a common, not universal, but a common attitude.
Okay, so I think we just have time for one more question before we close the webinar, so I should pick the most relevant one.
The easiest, please.
The easiest one. I'll pick a short one. So does your conclusion also apply to the bond market?
For the corporate bond market, we have to distinguish between treasuries and corporate bond market. From the corporate bond market, to the extent that I have leverage for the equity, clearly the corporate is deleveraged because it's a protected part of the capital structure. So yes, it does apply in the sense that the more vulnerable the equities are, the less vulnerable the senior part of the capital structure is. If we look at treasuries, it's completely different, because then it's not a capital structure argument, but is a question is, in different abatement policies, how is the transition financed? Is it financed by taxes? Is it financed by public debt? What is the part of the private investment? Which would take us on a very long discussion, but as the International Monetary Fund has recently written, there are very reasonable scenarios in which the public debt will increase very significantly, therefore putting a strain on the valuation of treasuries, of public debt.
Thank you, Riccardo, for the presentation and the discussion. I would also like to thank all participants for attending, and we're now closing the webinar. Thank you.
Thank you so much.